For selling and administrative expense budget, it's quite similar to what we've prepared for manufacturer overhead budget. Let's first take a look at additional information. At row year, the selling and administrative expense budget is divided into variable and fixed components. The variable selling and administrative expenses are 50 cents per unit sold. Fixed selling and administrative expenses are $70,000 per month. The fixed selling and administrative expenses include $10,000 in costs, primarily depreciation, which are not cash outflows of the current month. Let's prepare the company's selling and administrative expense budget. Selling and administrative expense budget includes both variable and fixed components. So we can use budgeted sales in units for each month, multiplied by variable selling and administrative rate to get total variable expenses, and plus fixed selling and administrative expenses to get total selling and administrative expenses. So here, for budgeted sales in units, we can get information from sales budget, multiplied by variable S&A rate 50 cents, and we can get $10,000 variable expenses for April. Fixed S&A expenses $70,000. So the total S&A expenses for April $80,000. We can also prepare cash for S&A expenses. Here, non-cash expense is depreciation. So we subtract $10,000 from $80,000, and cash payments for selling administrative expenses in April should be $70,000. And we can do the same thing for May and June to get total S&A expenses for the quarter $260,000, and subtract non-cash expenses, depreciation, and we can get cash selling and administrative expenses for the whole quarter $230,000. Based on the above budgets, we prepared cash receipts and cash disbursements. We can prepare cash budget. For cash budget, it's divided into 4 sections. Cash receipts section, which lists all cash inflows, excluding cash received from financing. Cash disbursements section consists of all cash payments, excluding repayments of principal and interest. Cash excess or deficiency section, it determines if the company will need to borrow money or if it will be able to repay funds previously borrowed. And financing section, it details the borrowings and repayments projected to take place during the budget period. Additional information. Assume the following information for row year. Maintains 16% open line of credit for $75,000. Here, 16%. This is annual interest rate. Open line of credit, which means the company can borrow cash from the bank at any time, as long as it does not reach the limit, $75,000, at interest rate 16%. Maintains a minimum cash balance of $30,000. Borrows on the first day of the month and repays loans on the last day of the quarter. pays a cash dividend, $49,000 in April. Purchases $143,700 of equipment in May and $48,300 in June. Both purchases paid in cash. And has an April 1st cash balance of $40,000. Let's take a look at the cash budget. The beginning cash balance in April, the question has told us $40,000. We plus cash collections. Cash collections for April $170,000. This is from schedule of expected cash collections after we prepare sales budget. It's from here, if you take a look at the previous slide. So we can get the total cash available, beginning balance plus cash collections. It's $210,000. And then we subtract all cash payments for materials, direct labor, manufacturer overhead, S&A, equipment purchase, or dividend. For these numbers, they are from the budgets we've prepared. Cash disbursements for materials, $40,000 in April. This is from the schedule of expected cash disbursements after we've prepared direct materials budget. You can go back to previous slide to find the number. Then for cash payments for direct labor, it's from direct labor budget. Here, $15,000 in April. Cash disbursements for manufacturer overhead in April, $56,000. It's from manufacturer overhead budget. Here. And then for S&A cash payments, that's from S&A expense budget. We just prepared $70,000 in April. Equipment purchase, not in April. Cash dividend is paid in April, $49,000. So we can add total cash disbursements together. Here, $230,000. We subtract total disbursements from total cash available. It's a negative number. So in April, the company has a deficiency, $20,000. But Roger company needs to maintain a cash balance of $30,000, which means the company must borrow $50,000 on its line of credit. So the company needs to borrow $50,000, and we put in the finance section. Total financing $50,000, and then we can get ending cash balance for April $30,000. And we can do the similar entries for May. Keep in mind, ending cash balance in April is the beginning balance in May. So beginning cash balance in May, $30,000 plus cash collections, and then we can get total cash available. And then we find out cash disbursements for materials, direct labor, manufacturer overhead, selling and administrative expenses from all those related budgets. Equipment purchase, $143,700 in May, paid in cash. So we put here. And no dividends paid, and we can get total disbursements $400,000. We subtract $400,000 from total cash available, $430,000, and we can get positive $30,000. This is excess. and $30,000 meets a company's minimum requirement. So the company does not need to borrow any cash, and ending cash balance is $30,000. For June, we do the same thing. And if we calculate, we can get total cash available $365,000. Total disbursements $270,000. And we will get positive number. For June, we do the same thing. Equipment purchase in June, $48,300, no dividend. So we can get For June, we do the same thing. The company has excess as well, $95,000. At the end of the quarter, the company needs to pay back loan, $50,000. So on the finance section, we subtract the repayments here, $50,000. For open line of credit, interest rate 16%. Again, 16% is the annual interest rate. At the end of the quarter, the company has accrued 3 months interest expense. We can calculate the interest expense. Principal multiplied by annual interest rate multiplied by time period. This is a formula to calculate the simple interest expense. So here, $50,000 principal multiplied by annual interest rate. Only 3 months interest expense. So we divided by 12 multiplied by 3. And we can calculate 3 months interest expense, $2,000. And we put it here. So the company has paid the cash for interest expense, $2,000. The total financing section here is negative $52,000. This is cash outflow. And the difference between $95,000 and $52,000 is ending cash balance in June. For the quarter, we can get the total cash available $945,000 minus total disbursements $900,000, and then we can get a positive $45,000. And of course, if you add up together for this line here, for those 3 months, you can get the same number. Borrowing and repayments cancel out, and the company has paid $2,000 for interest. So financing part negative $2,000. The ending balance for the quarter, same as the ending balance in June, which is $43,000.